Welcome to Module 22 of Accounting 5000. In Module 22, we're going to start talking about the managerial side of accounting, the internal piece of accounting. Previously, we talked about financial accounting, which is externally focused. In this chapter and for the next few modules, we're going to be talking about internal accounting or managerial accounting. Managerial accounting is tied to the planning and controlling of the activities of a firm. What we're looking at here tends to be looking at the future. What are we going to do? In order to plan, we figure out where we want to go, we set our goals and objectives, we then take action to achieve those goals and objectives. And the control part is when we look to see if we've done that, if we've actually accomplished what we set out to do. Management accounting plays a role in all of that. We help with the financial side of the planning. We help with the financial side of the controlling. Part of accounting is called cost accounting, and this is a subset of managerial accounting. The cost accounting part relates to actually putting prices or costs on items that we purchase to resell or items that we manufacture. So cost accounting will be a minor part or a subdivision of what we're going to talk about in the next few modules. In your book, at the top of page 414, there's a nice little chart that talks about the planning and control functions of managerial accounting. We're involved in setting the strategic goals, helping to put financial numbers onto those goals. We're involved in the assessing of what is actually going on in the operations from a financial viewpoint. And then we look at the results to see if we can improve what we're doing. And this, as you can see from that chart, it's a circle. It's a cycle in which we continually go through the process of setting our goals, seeing how we're doing, setting some new goals, and so on. So it's an ongoing process. And the managerial accountant is involved in this continually. We're focusing on the future. We're looking at what's going on and seeing if we're doing it right, or as right as we can do it. Now you'll notice that what we're doing here is involved in the internal side of the company. We're looking internally to the future. And remember, our financial accounting that we've talked about previously was externally focused, and it was reporting to outsiders. So there's quite a few differences between what we call managerial accounting and financial accounting. There's a nice little box in your text on page 415 which compares the two types of accounting. It looks at things like how often do we report? Often in managerial accounting we report daily, if not even more often, on what our activities are and what our costs are. It looks at the standards. There are financial reporting standards. There are no internal reporting standards because the needs of the company determine what is reported, when it's reported, and how it's reported. So as you look through that chart, you'll notice there are a number of differences between managerial and financial accounting. The one thing to bear in mind, though, is that both sets of accountants use the same data. We use the same set of financial information. One is just focused for external reporting, one is just focused for internal reporting. So we're not really doing anything differently, we're just using the information for a different purpose. In managerial accounting, remember that you're going to use a lot of the basic managerial concepts that you learn in Management 5000 or in your undergraduate management class. That authority and responsibility have to be tied together. So when you come up with some results of what's going wrong or what's going right, the person who can fix it has the authority to fix it, must also have the responsibility for fixing it. So the managerial accountant ends up working very closely with other people, other parts of the company, in getting them to help get their operations a little bit more efficient, perhaps a little bit better controlled. But you have to maintain all of those management standards of responsibility and authority as you're going through and doing your work with these divisions. As a management accountant, you're going to look at accounting information a little bit differently from a financial accountant. You're going to be looking at smaller numbers and a more focused area of the internal part of the company. So what we do is we take all those numbers, all that financial data that has been compiled, and we look at it from a managerial perspective and break down those numbers into classifications. And what we have is a set of classifications that we use for purposes of making decisions and for planning our activities in the firm. For example, we have two types of costs that we divide numbers into. We have what we call product costs and period costs. We also have such things as direct costs and indirect costs, variable costs and fixed costs. We have controllable and non-controllable costs. Again, that's a management term. We have differential costs, allocated costs, sunk costs, and opportunity costs. If you look at a chart that's in your book on page 416, you can see how all of these costs are broken down into a nice diagram of how they relate to one another. In the next few chapters, what we're going to be doing is taking all those different types of costs and showing how we can use them for planning and control purposes. So you may not understand all of the terms we're going to talk about today, but in the future, each one of those will come up in a different type of environment, so we can show you how they're going to be used internally. For example, let's talk about how costs are related to the volume of activity that we work in. We have two types of costs related to volume, what we call fixed costs and variable costs. Fixed costs don't change. No matter what our volume is, our fixed costs stay the same. So if you were going to diagram them on a chart, they would be a straight horizontal line. With zero being if we produce 0 units, we're still going to have this cost. If we produce 1,000,000 units, the cost will stay the same. That would be a fixed cost. That would be something like the depreciation on the equipment. Whether we're using the equipment at all, or whether we're using it all the time, 24 hours a day, the depreciation on the equipment would stay the same if we were using something like straight line depreciation. If we were using units of production depreciation, it would vary. In that case, it would be what we call a variable cost, in that the more we produce, the greater the total cost would be. So if we produced 1 unit, we would have a little bit of variable cost. If we produced 1,000,000 units, we would have a much greater sum of variable costs. Typically, our variable costs are things like materials and labor, because the more we make, the more materials we use, the more labor we use. So the first step we do is to divide our costs into what we call variable and fixed costs. And these are totals. Variable costs change in total as production changes. Fixed costs do not change in total regardless of the amount of production that we have. All of our variable costs and all of our fixed costs added together will equal our total costs. So we can take our total costs and divide them into one of those two types of costs. Two things to remember when we talk about variable and fixed costs are the relevant range and the linear relationship. Typically, a company works in what we call the relevant range. They work from, say, a production capacity of 4,000 to 6,000 units. That's the range that's relevant to that company. If you're trying to make decisions for 20,000 units, that's way out of where they're usually operating. That's not in their relevant range. Typically, they work in that range. We're also going to assume a linear relationship. In other words, that our variable costs go up in a line, in a diagonal line, and that our fixed costs are linear in that they are a straight horizontal line. Now, this is not always true, because sometimes you can buy a certain quantity of goods for a certain price. The more you buy, the less the cost. So it would be almost a curve relationship. We don't use that. We assume a linear relationship. This makes our analysis a little easier. As we go on in discussing managerial accounting and looking at some of the types of decisions we make, we will include the idea that you may get a discount on quantities of purchases. But right now, we're going to assume that everything is linear and that we're only going to be working in a specific range in which the company usually operates. Let's talk a little bit about some of the examples of variable and fixed costs, just to give you an idea of what we're involved in here. And then we'll work a few examples on how we can do some analysis with this type of information. Remember, variable costs are those that change in total depending on the amount of production that we have. And we said earlier, things like the materials that are used in making the product, that's what we call direct materials, the labor that's used in making the product, what we call direct labor, and some of the manufacturing overhead will all be variable costs. They will change in total as we produce more items. Fixed costs, however, stay the same regardless of our production capacity and what we're doing. Things like our depreciation, the salaries of our supervisory personnel. There are a couple of others that are fixed costs. The insurance probably doesn't change. That would be a fixed cost. The total doesn't change depending on the amount of production that we're doing. So those are some good examples. Now, what do we do with this? Well, in order to get a real good picture of the firm, we need to take all of our costs and divide them into those two categories, fixed and variable. However, this becomes kind of a problem with some costs because they're what we call mixed costs. In other words, they have components of both fixed and variable in them. For example, electricity is often a mixed cost in that the supplying of the electricity to the place of business is a flat sum, say $200 a month. And then they add on a per kilowatt cost above that. So the fixed cost would be the $200. No matter what happens, they're going to pay that. That's just to have the service to that particular plant. Then the more electricity they use, the higher their cost will be. That's what we call a mixed cost or a semi-variable cost. It has components of both fixed and mixed. Well, in order to do some analysis that we need to be doing in the next few chapters, we need to divide those mixed costs into their fixed cost component and their variable cost component. And being accountants, we have come up with a way to do that using some numbers in what we call the high-low method. In the high-low method, what we do, we take total mixed costs, and we divide those total mixed costs into the variable piece and the fixed piece by looking at the difference between our total cost at the highest level of activity, the lowest cost, and dividing it by our high activity minus our low activity. So that second bullet there on the screen in front of you is how we use the high-low method. Now remember, total cost is equal to variable cost plus fixed cost. The variable cost is computed by taking the numbers that are in parentheses on that last bullet, the variable rate, which is the per unit variable cost, times the number of units we produced, or what's called activity here. That's the number of units we produce, or the number of units we use. So we do a lot with the high-low method to divide up our mixed costs into components of fixed and variable. Thereby we break out all of our costs. Some are obviously variable, some are obviously fixed. Then we can take our mixed and divide them up, so all of our costs fall into one of those two categories. So let's do a couple of examples on how we're going to use these types of costs, and then in the next module we're going to use those in some real-world examples. So let's look at exercise 12-1 to kind of get a handle on what types of costs are fixed and what types of costs are variable. Problem 12-1 is at the top of page 439 of your textbook, and what they've listed for you are a number of different types of costs, and they've given you two columns, variable and fixed. Let's see what we can do with each of these costs. For example, wages. Wages, we're going to assume that this is direct materials. Wages would not be direct materials. We're going to assume these wages are direct labor. In other words, the more we make, the more we're going to spend. So those would be variable costs. Depreciation, we're going to assume that the depreciation is a straight line or some of the year's digits or some set amount of depreciation rather than a units of production. So that would be a fixed cost. Glue would be a variable cost. The more units we make, the more glue we would use. Shipping would be a variable cost. The more products we make, the more products we have to ship, so the higher the cost total would be. Handling of raw materials. The more we make, the more we're going to have to handle those raw materials, so that would be a variable cost. The public relations manager's salary would be fixed because it doesn't matter how many units we produce. The public relations manager will make the same amount of money no matter what we do. Setup costs. Setup costs are getting the machinery in place ready to produce your items. Those would be variable costs because the more you produce, the more you're going to have setup costs. Then we talked about utilities. Utilities will have pieces of both variable and fixed, in that part of the cost will be just to have the service provided to the plant, and part of the cost will be the variable amount that the more you use, the more it will cost you in money. The same thing is true of your electricity at a retail store. It will have a variable and a fixed cost to it. And finally, research and development expense. That could also be both a variable and a fixed. Typically you have salaries that would be the fixed part, but the more research you do, the more supplies you have to buy, so that would be the variable part. So research and development can have components of both. Well, let's look at some numbers now that we've looked at some concepts, and let's use problem 3 as a way to see the relationship between fixed and variable costs. In problem 3 you have a young man, Ryan, who estimates that the cost of insurance, license, and depreciation to operate his car total $320 a month, and that the oil, gas, maintenance are 15 cents per mile. He also estimates that on the average he drives his car 1,400 miles per month. In Part A, they ask you how much it would cost him during April if he drove the car 1,529 miles. Well, if you're going to compute the cost for 1 month, you're going to take the fixed costs, which would be $320, and you're going to add to that the 14 cents a mile times the number of miles he drove, which would be 1,529. So the total cost to operate his car in April would be $534.06. Then in Part B it says, would it be meaningful for Ryan to calculate an estimated average cost per mile for a typical 1,400 mile month? Obviously it would not, because the average cost would be trying to divide fixed expenses by the number of miles, and there is not a valid reason to do that. That fixed cost wouldn't be useful for you for anything. So you need to keep the cost into a fixed component and a variable component, and that allows Ryan to calculate his total cost regardless of the activity for that month. Let's look next at problem 11, which is on your textbook at the top of page 442. Problems 11 and 12 deal with the high-low method, so these two problems are very important. I want to go through and talk pretty much in detail about problem 11, and then give you a chance to work on problem 12 on your own with a few helpful hints as we go along. In problem 11 it says you have a department of Gamma Company that incurred the following costs for February. Variable costs and the variable portion of the mixed costs are a function of the number of units of activity. During April, the activity level was 8,000 units and total costs were $70,500. In Part A, it asks you to compute the variable, fixed, and mixed costs for April. Okay, what we need to do then is to look at the costs that are in that box, which are the costs for February, and you see that at 5,000 units of activity, we had $10,000 in variable cost, $30,000 in fixed cost, and $20,000 in mixed cost. So what they want us to do is to take those same numbers and figure out the costs for April. The only difference is that we had 8,000 units of activity in April, and in February we only had 5,000 units. Well, now think about what variable costs are. Variable costs go up depending upon the activity or the number of units you produced. Well, if our variable costs are $10,000 and we produced 5,000 units, then our variable cost per unit would be the 10,000 divided by 5,000, or $2 per unit. That will be true in April also. So if we look at April, our activity is 8,000 units. We know our variable costs are $16,000 because we take the $2 times the 8,000 units. Our fixed costs will not change. Our fixed costs in February were $30,000. We know our total costs were $70,500. That was given to us. So we can compute the mixed costs, the missing number. Okay, now that we know those costs for April, the fixed, the mixed, and the variable costs, we can do the high-low method, which is what they're asking for in Part B. Use the high-low method to calculate the cost formula for those mixed costs. So what we're going to do is take that $20,000 of mixed cost that we had in February, and we're going to take the mixed cost that we had in April and divide them up into variable and fixed part. So your formula is the first thing that's shown on the slide that you're looking at now. It says high dollars minus low dollars divided by high activity minus low activity. Well, your high dollars were in April, and they were $24,500. Your low dollars were in February, when you had $20,000 worth of mixed cost. Your activity levels were $8,000 in April and $5,000 in February. So you end up with $4,500 divided by 3,000 units, or $1.50 per unit. That's your variable cost per unit in your mixed cost. Now remember, we said that total cost equals variable cost plus fixed cost. We know the variable cost component is $1.50 per unit. We know there were 8,000 units. So 8,000 times $1.50 is $12,000. So the variable cost component of our total cost is $12,000. Total cost is $24,500. So our fixed cost has to be $12,500. So that's the way you break down your mixed cost into variable and fixed components. Let's practice one more time by using problem 12 as an example. In problem 12, you have the following data for Puzzle Company. They give you the production level for both months. They give you the variable costs for June, but not for November. Now you can compute those, right? For June, you take the $21,000, divide it by the 12,000 units, and you'll find a variable cost per unit, $1.75. The variable cost won't change from month to month, so you take the $1.75 and multiply it by the 18,000 units in November, and that will give you your variable costs for November. Fixed costs don't change, but fixed costs are shown in November at being $31,000, so you know they're going to be $31,000 in June also. They don't tell you your mixed cost in November, but you now have your variable costs and your fixed costs, so you can figure your mixed cost by subtracting them from your total cost. So it asks you to calculate the missing costs in the first section. What you see on the slide in front of you are the breakdowns for June, the variable cost, fixed cost, and mixed cost. And then you have the information presented to you for November, the same way we just talked about. Now in Part B, they want to calculate the cost formula for mixed costs using the high-low method. Remember how we compute high-low method? We take the high dollars minus the low dollars divided by the high activity minus the low activity. You see the calculations there, and you find that your variable cost component in the mixed cost is $1.25. Well, if you know it's $1.25, you can take that times your activity level, and it doesn't matter which activity level you use. You can use either the 18 or the 12, you get the same answer. I use 12 because it's a smaller number and easier to compute. $1.25 times 12,000 is 15,000. You know your total mixed cost is 18,000, so your fixed cost component of your mixed cost will be $3,000. Then it asks you to calculate the total cost that would be incurred for the production of 20,000 units. Okay, you're going to have three calculations there. Your variable costs, your purely variable costs, are $1.75 times 20,000. Your fixed costs don't change from 31,000. Your mixed cost, you've got a fixed cost component of 3,000. You've got a $1.25 variable component. So you add those together, you get 28,000. So your total amount there for 20,000 units would be $94,000. And in Part D, they ask you to identify the two key cost behavior assumptions that are made in calculating Part C. Remember we said those were that we are assuming a linear relationship, 2 points make a line, and we're assuming that we're working within a relevant range, that we're staying within the range in which the company actually produces goods. So what we've done in this module 22 is to go through and look at the different types of costs, variable and fixed, and we've looked at a method for dividing up those costs that are not purely variable or purely fixed into two components of variable and fixed within the mixed cost. We're going to continue this chapter with module 23, where we're going to show you how to use that information to help make managerial decisions.